Coming up on Market to Market. The governor of a leading farm state negotiates agricultural trade with China. Heavy rains bring much-needed moisture to the grain belt and push rivers to flood stage. And with spring planting on hold, an expert suggests changes to nitrogen management plans. Those stories and market analysis with Tomm Pfitzenmaier. Next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, April 26th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The U.S. economy grew significantly in the first quarter of 2013, bolstered by the strongest consumer spending in more than 2 years. The Commerce Department reported Friday that U.S. gross domestic product, the broadest measure of the economy, grew at an annual rate of 2.5% from January through March. Consumer spending, a key driver of economic growth, surged at an annual pace of 3.2%, reflecting its biggest increase since 2010. Government spending, on the other hand, fell at a 4.1% annual clip as deep cuts in defense spending held total GDP below expectations of 3% or more. The notion of slowing economic growth brought out the bears Friday as major stock indices and most commodity prices declined precipitously on the news. Last week, after China reported its economy also slowed in the first quarter, equity markets posted their largest weekly decline in more than 5 months. But with a population of nearly 1.5 billion people, China continues to be a lucrative market for U.S. exports. And last week, farm state leaders sat down with Chinese officials to negotiate agricultural trade. While trade missions to foreign countries are normally a blip on the import-export scene, one group of governors and business people embarked on a noteworthy 6-day visit to China last week. The key difference with this trade summit and most other junkets of this nature is that two leaders have a history reaching back over 2.5 decades. Iowa Governor Terry Branstad, not traditionally regarded as a power broker in Chinese-American relations, made his second trip in a year to the world's most populous nation. Among the 50-member group of business leaders and politicians were Republican governors Scott Walker of Wisconsin and Bob McDonnell of Virginia. Their 4-city tour included visits to an agricultural university, an automotive plant, and meetings with Chinese officials.
Welcome back to Iowa.
Iowa Governor Branstad also met privately with Chinese President Xi Jinping. The 45-minute face-to-face was described as warm and cordial. According to Branstad, Xi spoke highly of the Hawkeye State and its people. Rural America is not completely foreign to Xi Jinping. A 1985 agricultural research trip brought the future Chinese leader to Iowa, where he spent time on a farm near Muscatine and was initially introduced to Branstad during the Iowa governor's first term. Xi returned to Iowa in February 2012 before ascending to his position as China's top official to visit his former host family and attend a state dinner. Though the nation, once referred to as a sleeping giant, is a huge importer of agricultural goods, no new trade agreements were formally announced. But Branstad described the trip as extremely productive. Officials rely on a sophisticated network of monitors to keep an eye on America's waterways. But beginning next month, more than 100 crucial gauges that warn of imminent flooding or lack of water will be shut down due to federal spending cuts. The 8,000 gauges across the nation are paid for by a combination of funds from federal, state, and local governments. Last year, the federal government spent nearly $29 million on the gauges, while the locals chipped in $116 million. But the sequester cuts 5% from the federal share, and that means shutting down a handful of gauges in each state. And if the weather this month is any indication, that may be a very bad idea. The rain on the plain was mainly a pain for many in rural America this week. Several rivers escaped their banks in Illinois, Missouri, and the Dakotas. High water in Spring Bay, Illinois, near Peoria, flooded homes and other low-lying areas. Roads were closed and some areas of Peoria Heights can only be reached by boat. Heavy rain contributed to the rise in water, which was beginning to recede by midweek.
Well, I think on the outside right now it's probably about like 2 feet. It did starting to recede a bit. It dropped about 4 inches since it crested.
Floodwaters in Peoria topped 70-year records along the Illinois River. Downtown Peoria was overrun by tens of thousands of sandbags and dozens of pumps trying to hold back the water. Historic landmarks were inundated as residents documented the situation. Even some homes in East Peoria were deemed unsafe after a massive landslide. The high Illinois River has contributed to a reduction in river navigation. The U.S. Coast Guard and Army Corps of Engineers are urging recreational boaters to stay off the Illinois, Mississippi, and Missouri rivers between Alton, Illinois, and the Port of St. Louis. Several locks were closed because of the high water. Along the Missouri town of Clarksville, pumps are working overtime to expel the water from protected areas. Levees are being reinforced with help from the National Guard in the area between Hannibal and St. Louis. It has been a long, tiresome stretch for local officials who believe it could continue for another month.
The chief concern right now, I think, is just diligence and watching what we have done to make sure that there is not a breach of any kind. That will mean a 24-hour-a-day watchful eye.
The mayor of Clarksville, like many on the front lines of this flood fight, knows current conditions can only be exacerbated by what happens upstream.
It can change in an instant. It could change if, in fact, we have a deluge of rain above us and the river should go higher than we can handle. Then we'll have to increase the height of the wall that's there. And it can be done, but we'd have to pull things back together really fast.
Downstream in St. Louis, water is spilling out of the riverfront. Just a few months ago, barges were grounded here because of low levels. This week, about a dozen barges broke free and started floating downstream. One National Weather Service hydrologist puts this flow change into perspective.
It's not entirely unheard of, but for the river to go as low as minus 4.6 feet all the way up to 35.2 as it is right now is considerable. And we really haven't, I've looked back in history trying to find comparable events, and there's a handful, but I have to go all the way back into the 60s, early 70s perhaps, to find anything close to that.
Back north in Fargo, North Dakota, crews continue to prepare against the fourth major flood in 5 years. Large clay walls are being assembled along the Red River. Depending on actual river crests, the Army Corps could build anywhere from 4 to 7 miles of emergency levees. And the impact of more rainfall was reflected in the drought monitor. Cool and wet conditions contributed to a reduction again this week in the 4 stages of drought. In the contiguous U.S., 60.2% of the country is in some form of drought, a nearly 2% improvement over the week before. Recent rains aside, this week's level is almost the same as it was a year ago at this time. The moisture is proving to be a mixed blessing, as soggy conditions are delaying field work. Planting progress is creeping along at one of the slowest paces in years. This week's USDA report revealed only 4% of corn is in the ground. Little, if any, corn is planted in key growing states. Colorado, Iowa, Michigan, Minnesota, Nebraska, North Dakota, South Dakota, and Wisconsin all are well behind pace with no measurable progress happening. The 5-year average for this week is 16%. Forecasters are calling for warmer and drier weather this weekend and into next week, offering a welcome reprieve for flood-weary residents and America's farmers. While experts are hesitant to say the drought is officially over, mild and dry conditions in the days ahead should allow field work to begin in the Midwest. And some planters likely will run well after dark until the threat of rain returns late next week. But while planting is at least a couple of weeks behind, cool temperatures and timely April showers have greatly increased soil moisture in much of the Corn Belt. As usual, though, there's a trade-off. Believing the rains have washed away precious nutrients, some experts are calling for a thorough examination of nitrogen management plans. Last year, the worst drought in half a century devastated America's row crops. Early in 2013, some believed that dry conditions could continue through this year's growing season, greatly reducing the amount of nitrogen applied to America's fields. Well, it's not uncommon for 40 to 50 pounds of nitrogen per acre to carry over from one season to the next. Soil samples taken last fall by Iowa State University indicated that some fields could see as much as 100 pounds of carryover. However, water samples taken by the Iowa Soybean Association, or ISA, indicate that wet weather this spring has caused a fair amount of nitrogen loss.
We're seeing a little bit higher concentrations than we typically do, primarily related to the drought. I think it just confirms that leaching is an issue, and farmers see it as money going down the river too. So there may be an opportunity, depending on how much it rains between now and planting time, to cut back on rates and possibly save a little bit of money since there's such a bank of nitrogen in the soil. But when we see these high levels, that means it's leaching out and won't be available in another month or two.
While nitrogen is not usually applied to soybeans, the Iowa Soybean Association does research on corn to provide information to its members who raise both crops in rotation.
So the question right now is, if this weather continues, what's the game plan for the nitrogen management for corn in this season?
According to USDA, 69% of U.S. cropland planted with major field crops, some 167 million acres, receives commercial and/or manure nitrogen. Corn accounts for 45% of U.S. acreage receiving manure and 65% of the 8.7 million tons of nitrogen applied by farmers each year.
We don't know what happened next, but definitely it changes the game right now. With all this rainfall we got for the last 3-4 weeks and saturated soil, we probably will lose some nitrogen from the last year.
This season, the Iowa Soybean Association suggests that growers do a late spring or pre-side dress soil nitrate analysis in May or early June, when corn plants are 6 to 12 inches tall. The test predicts the amount of nitrogen available before the plants begin extensive uptake of nutrients. According to the ISA, if the test shows less than 21 parts per million nitrate, the probability is high that the cost of an additional application of nitrogen would be covered through additional yield.
Next, the market-to-market report.
Grain prices declined this week, due in part to the stronger dollar and an improving weather outlook. For the week, July wheat lost 19 cents, while the nearby corn contract moved 13 cents lower. Soybeans traded sideways as the July contract posted a weekly loss of 2 cents. Nearby meal prices bucked the bearish trend with a gain of $2.20 per ton. In the softs, cotton prices also declined this week as the July contract posted a weekly loss of $1.10 per hundredweight. In the dairy market, June Class 3 milk lost 37 cents, while the deferred July contract moved 2 cents higher. It was a big week in livestock, where the June cattle contract rallied $1.10, August feeders advanced by more than $5, and the June lean hog contract gained $2.32. In the financials, the euro lost 33 basis points against the dollar, crude oil gained $1.71 per barrel, COMEX gold declined by $47.80 per ounce, and the Goldman Sachs Commodity Index gained more than 10 points to settle at 621.50. Here now to lend us his insight on these and other trends is one of our regular market analysts, Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Mike.
We mentioned at the top there, stronger dollar. We've been seeing it happen for the past 3 or 4 months. It's continuing to strengthen. Where do you see the dollar headed?
I think it's going to continue. I think we're in an upward trend. It's going to obviously going to have corrections along the way, but the Japanese government or the Bank of Japan has pretty much told everybody that they're going to have a policy of more QE, and have worked hard to try and depress the yen. So I think that strength against the yen is going to continue. In Europe, they continue to have problems. Their GDP is struggling. Some of the indicators out of Germany aren't all that great. I just think there's a lot of people concerned about the U.S. economy and all that, but relative to everybody else, it looks to me like the dollar is going to continue to work higher, and if it does, it's going to be a problem for all of our commodities.
Now, is there anything out there, in your opinion, that could cause us to experience a correction in the short term, or how high do you see the dollar going?
I guess I don't have an upward number to give you. I just think the trend's going to be higher, and it's going to be a problem, I guess. That's all I can say about it.
It's going to depend on worldwide events that right now are...
Right. I mean, the Europeans are starting to kind of balk at all this austerity that's being asked of them, saying austerity without any stimulus is just going to lead to more unemployment, and so that whole thing is sort of festering, and I think eventually is going to be a problem for the euro and a benefit to the dollar, if you want to put it that way. So I just think all those factors over time are going to contribute to the dollar working higher.
Certainly. And a benefit to the dollar could be a concern for our exporters, primarily in the grains. Let's talk wheat a little bit. American wheat producers have had a rough winter and spring, and just pounded by more freezes and late germination, and yet we don't see the market going any higher. It just continues to slip lower. What's
That's
happening?
all domestic supply stuff and production stuff, and I think the wheat market is way bigger than that. The world supplies, when you have high grain prices like we've had in corn and wheat, then it incentivizes everybody in the world to grow wheat, and there's a lot of people who can. So I understand if you're a domestic producer, there's a lot of head scratching on. I'm having all these wheat problems with my wheat, and yet wheat prices keep going down. But I'm afraid that's probably going to be a trend that's going to continue in both the corn and the wheat market.
For producers who didn't have much hedging in place, what's the best way to work with this type of falling wheat amid potentially falling yield situation that they're dealing with?
Well, the old adage is, in a downturning market, the faster you can sell, the better off you are. So sitting here horsing around, griping and complaining about declining prices probably isn't going to do you a lot of good. There's going to be little up pops, and I think you need to use those as selling opportunities. But certainly sitting on a bunch of wheat in your bin, I don't see is going to do you a whole lot of good.
It's not going to turn around anytime soon.
I don't believe it will, no.
Let's take a look at soybeans. We've seen soybeans be the bright spot all winter long, and it's more or less continuing. Where do you think beans are headed? Well,
you got two situations here. I think old crop beans are going to be well supported. They're having a devil of a time buying any beans from the farmer, number one. Number two, exports are going to, we had negative exports this week, mainly because of Chinese cancellations. So exports are going to be a problem. On the positive side for old crop beans is our meal exports have been very, very good. So we need to crush a lot of beans to produce the meal to be able to export it, and that's the question: is where are these processors going to get those beans to do that? I mean, there's areas in Iowa where the processors are bidding $1 to $1.10 over the board, July board, just to get their hands on some beans that aren't all that available. So I don't think they're going to be available until you get close to $15. So if you assume that kind of basis, that means $14.20 to maybe $14.50 on old crop beans is probably going to be the upper limit, assuming those kind of bases and assuming the farmer sells at 15 plus.
Certainly, if that's
on the cash
trigger.
side. On the other hand, is you got the new crop, which is fighting a huge, big South American crop. The logistics down there are gradually getting sort of worked out. We're probably going to see decent acreage. The moisture we're getting here is going to give us a better chance for decent yields. So I think upside potential on November beans is limited to probably 12 to 12.20, and you get up in those levels, I think you probably need to turn into a seller of some sort.
Take advantage of those rallies.
Exactly.
And how much would you be looking to sell as summer goes on when we get into that 12.20 rally?
Yeah, this time of the year, I'm inclined to not go beyond 30 to maybe 45%. If you get the crop up and going and it looks good, then I think you can bump that up pretty good.
Take additionals.
Yeah.
Well, let's take a look at corn. The corn market, again, poor export news is continuing to happen. Where do you see old crop corn headed?
Exports are terrible. They're going to stay terrible. Everybody's assuming they're going to be terrible. The USDA may even adjust that down a little bit again in the next WASDE report. The real driver here, I think, is probably going to be the ethanol industry and how they respond. I mean, ethanol margins are good. The production is above what we need to have on a weekly basis to meet the USDA's projections. I would not be a bit surprised in that next supply-demand report to see some bushels move from exports and added onto the ethanol side. So I think that's going to be the driver. The question is that corn that the USDA or the stocks report said we had, do we have it? And maybe another step beyond that is the farmer that owns it going to be willing to sell it. Because if it's there but they won't sell it, it doesn't really mean a whole lot. And I think there's a fairly large number of people that are sitting on corn, just waiting to see how the spring planting goes. We have all this wet weather that delays that decision. And I think if you get past May, June, July, they start to see that they're going to get a good crop, then maybe we'll see some corn move. The basis has been continually strong. The basis has been a fooler for people. We've watched that all winter long thinking, well, the basis is high. They're not buying corn. There must not be any. And that's deceived people. If you step back 20 feet from a corn chart and look at it, we've been in a downtrend in that since September, a major downtrend. And I don't see anything that's happening that's gonna stop that. We've got a big crop probably coming on in the fall. Everybody looks ahead and sees that. The funds have bailed out of all these commodities. They have no interest in owning them, and they're big part of the reason why we went up. As long as they're bailing out, the equity markets are strong. They're looking at it and say, well, why do I only want to own commodities? Look at what gold did, another example. And we're going to be fighting that, and it's going to be a problem.
All right. Now, as we look at that chart from 20 feet away, where do you see a potential floor being for new crop corn?
I think new crop corn is going to be fairly well supported initially in that $4.80 to $5 range, so we didn't get too far from that this week. Over time, I think you're going to see it work down toward $4.50, $4.30, somewhere that gives more like a $4 cash price.
All right.
Or maybe even under if the crop really looks good.
All right. Well, let's talk a little bit about cotton. We've seen a downtrend in cotton similar to corn over the past 3-4 weeks. It's been dropping. What are your thoughts there? Going to continue to fall?
Well, that's due primarily to China and India dumping some of their domestic stocks. I think that's been the driving force behind that. We've dropped it from cotton from 94 down to the mid 80s. I think you're probably going to see fairly good support show up in that 82 range, and then we'll have to see where we can go from there, I guess.
Certainly, and we're probably still going to see yields, or not yields, but acres continuing to be bought by corn.
Yeah, I think there's a trend away from cotton and toward probably soybeans in those production areas. Although, down in the Delta and the Southern Corn Belt, they've been having a lot of their forecasts are a little wetter than ours, and up here in the Northern Corn Belt are. So that may be a problem for everybody.
All right. Well, now taking a look at livestock, as we've watched this corn continue to fall, we saw feeder cattle this week get a pretty good spike. We saw a $5 spike in prices this week. What are your thoughts there? We have a perception of grains going lower, and then we've had a nice little bounce in the live market this week, and I think the combination of those has given some pretty good support to the feeder market. Now that market has been depressed fairly well because I think finally feeder producers have said, we're not going to pay up for these feeder cattle. We're tired of losing money, and we're not doing it for a while. Well, the numbers are going to dictate that there's probably a fairly good support somewhere down in current levels or maybe a little under. And then if we get cheaper corn and we can get some strength in the fat market, there's probably an upward draft to that market, although I wouldn't get wildly bullish on it for a while, I guess. Okay, probably just some stability.
Right, exactly.
In the feeder market. Yeah. Now, taking a look at live cattle, we did see a nice run up, $1.10 on June in live cattle, and so it's up around $1.20, $1.21, and we've heard calls from $1.28 in Kansas and other places. What does that tell you about the live market? How high can it go, do you think?
We've been talking about it for a year now. The numbers are bullish to cattle. They've been bullish for a year. The problem is you can't sell the expensive beef to anybody. That's what we continue to fight, and everybody gets all revved up every time you got these little pops up in the market. But part of that is aggravated by the fact that the funds are heavily short cattle. So they get spooked a little, decide to take profits, pop up you go. Then you run into the fact that nobody wants to buy the beef on that pop-up, and then it stalls out again. October cattle are up around 126. There are some people think that price could move up to 128. Certainly is possible. The June contract at 123, 122 plus this week could move up into 124, 124 and a half. That wouldn't surprise me, just on the fact that it got oversold, the funds cover a little, and up you go. But that market, along with the pork market, are going to be fighting this dollar issue also. The one benefit that may come along is I think we're probably going to see cheaper gas prices through the summer into Labor Day. And that's going to put a little more money in the consumer's pocket and maybe a little helpful on the demand side. We're also going to have to see if May's beef month. We'll have to see if that stimulates any extra demand. The grilling season's been terrible up to this point. It's cold, it's wet. Nobody wants to go out and do it. If the weather changes, that might help a little bit too. And that may have been part of what's behind the markets pop up this week a little bit.
Getting a little bit of that weather change because we did see a pop in lean hogs as well.
Yeah.
Being just carried on that sentiment, is that sort of the same technicals we've got going on in the hog market?
Yeah, again, I don't think the upside's very great from here. Maybe another $2 or $3 more. But again, you're going to be fighting demand, fighting that stronger dollar. And that's probably going to be it for the hog market. I think you use those rallies as selling opportunities.
Now, as we look at the demand picture as a whole, hopefully, like you say, we're going to see grilling season pick up. And as we look at this stronger dollar, how much is that going to affect pork prices over the summer if we continue this strengthening trend?
Well, it's not going to be good because we export a lot, particularly to Asia. I don't know. Maybe they struck a deal on this trip you just talked about earlier in the show. But all that does help. But I just think it's going to be a headwind. I don't know that you can say it's going to limit it by $2 or whatever, but it's just going to be a headwind for the market. Definitely.
One of the things that's going to weigh on people's minds as they're looking to the future.
We just really need some consumer confidence, consumer to feel better about spending a little money, and like I said, maybe lower gas prices is going to contribute to that. But,
certainly. People are saving cash on gas. They'll upgrade from a hot dog.
Everybody thought things were going to be better, and then we have this disappointing GDP number on Friday. So then everybody says, well, maybe things aren't quite as, is the sequester really hurting us? Right. All that kind of stuff.
Thank you so much, Tom. Appreciate you being here today.
No problem.
That wraps up this edition of Market to Market. But if you'd like more information from Tom on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll examine the impact of the government's latest figures on unemployment. And until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.